If you could turn your W-2 income into tax-free wealth, would you want to know how? Today, I'm revealing one of the most powerful, misunderstood, and underutilized tax strategies in the entire tax code, the real estate professional designation. I'm Tiffany Phillips, CPA and tax strategist, and I help high-income earners and business owners keep more of what they earn legally. I've had clients who were paying over $100,000 a year in taxes completely eliminate their tax bill using this approach. And by the end of this video, you'll know exactly how to use it yourself, even if you're a high-earning W-2 employee. Most people buy rental properties hoping for cash flow and appreciation. But wealthy investors, they buy real estate for the tax benefits first. Everything else is just a bonus. Let me tell you about a client, a software engineer making $200,000 a year, married, 2 kids. Before working with me, they were paying about $60,000 a year in taxes. Within 6 months of implementing the real estate professional strategy, their tax bill went to zero, not reduced, eliminated, and they did it completely legally. Here's how it works. The IRS has a special classification called real estate professional status. If you qualify, you can use real estate losses to offset your ordinary income, including your W-2 agent. Normally, passive activity loss rules prevent you from using rental real estate losses to offset your regular income. But real estate professionals are exempt from these rules. If you qualify, your real estate activities are considered active, not passive, and active losses can offset any type of income. W-2, business, investment, everything. So how do you qualify? There are 2 tests. Number 1, you must spend at least 750 hours per year in real property trade or business activities, about 14 and a half hours per week. Number 2, you must spend more than half of your personal service time in real property activities. If you work a 40-hour per week job, you need to spend more than 40 hours per week on real estate. Most W-2 employees can't meet this test, but here's the secret. If you're married and filed jointly, either spouse can qualify the entire return for real estate professional status. Let's go back to that software engineer. He worked full-time, so he couldn't qualify. But his wife, she was a stay-at-home mom, and she managed their real estate portfolio. She handled tenants, maintenance, research, and documented everything. She easily spent more than 750 hours and more than half her working time on real estate. Once she qualified, their entire joint tax return benefited. Real estate losses could now offset his W-2 income. And this is why I always say, if you're married and one spouse has flexibility, you have a huge tax advantage waiting to be unlocked. Here's where it gets really powerful. We didn't just rely on normal depreciation. We used cost segregation to accelerate depreciation and create massive deductions in the first year. Normally, you depreciate a real property over 27 and a half years. But with cost segregation, you can identify components, carpeting, appliances, landscaping, fixtures that can be depreciated over shorter lifetimes, 5, 7, or 15 years. A good cost segregation study can accelerate 20 to 30% of a property's value into the first year. On a $300,000 property, instead of $11,000 in appreciation, you might get $60,000 to $90,000 in the first year deductions. Buy 2 properties, and you could create $150,000 to $200,000 in deductions in year 1. At a 30% tax bracket, that's $45,000 to $60,000 in tax savings. Let me share a real example. A consultant making $400,000 a year, paying $120,000 in taxes. His wife left her job to start a family. They bought an $800,000 rental property. Through cost segregation, we accelerated $240,000 of depreciation into year 1. Combined with other expenses, they had a $270,000 real estate loss. Because his wife qualified as a real estate professional, they used the entire loss to offset his consulting income. Their tax bill dropped from $120,000 to $30,000, a $90,000 savings in 1 year. And the property was cash flow positive and appreciated $60,000 in year 1. They got their entire down payment back in year 1 through tax savings and appreciation while keeping a cash flowing assets. You might be wondering about depreciation recapture. When you sell, you do have to pay back some of the depreciation, but you can defer this with like-kind exchanges or hold the property until death and pass it on to your heirs with a stepped-up basis. The key is you get the tax benefit today when you need it most. Now, let's address the elephant in the room. Is this too good to be true? What if I get audited? Real estate professional status is one of the most scrutinized areas of the tax code. The IRS knows how powerful it is, so they pay attention. But you shouldn't be afraid. Just do it right. The key is documentation. You need a contemporaneous log. Record your activities as they happen, not months later. Log the date, time spent, and specific activity and property. Activities include advertising, showing properties, collecting rents, coordinating repairs, researching markets, education, and more. You don't need dozens of properties. I've had clients qualify with just one or two. It's about the time and effort you put in. Let's talk advanced strategies. One of the most powerful combos is real estate professional status plus short-term rentals. If your average guest stay is 7 days or less, you get even more favorable tax treatment. Short-term rentals aren't subject to passive activity loss rules, even if you don't qualify as a real estate professional. Another strategy, grouping election. If you own multiple rentals, you can group them together for passive activity loss rules, making it easier to qualify and maximize deduction. Some of the common pitfalls: don't try to retroactively qualify. The IRS requires contemporaneous records. Don't misunderstand the more than half test, and don't try to use this with properties that are clearly personal use. Work with a tax professional who understands these rules that can help you structure your activities properly from the beginning. If you're interested in exploring real estate professional status, start documenting your time right now. Don't wait until next year. Start keeping a detailed log of any real estate related activities you're already doing. If you're married and one spouse has flexibility, talk about how you can structure your real estate activities to maximize your tax benefits. Even if you only own 1 or 2 properties, you can still qualify and see massive tax savings. And don't forget, you can combine this with other strategies like 1031 exchanges, bonus depreciation, and even self-directed retirement accounts to supercharge your wealth building. Let's wrap this up. The real estate professional designation is one of the most powerful tax strategies for high-income earners, but it's also one of the most misunderstood and underutilized. When implemented correctly, it can eliminate your tax liability while building long-term wealth through real estate. But it requires planning, documentation, and treating your real estate activities like a business. If you want to dive deeper into real estate professional status and other powerful tax strategies, grab your copy of my book, Your Biggest Expense, at yourbiggestexpense.com. The link is in the description below. Don't just learn about these strategies, implement them. Knowledge without action is worthless. The question isn't whether these strategies work. They absolutely do. The question is whether you're going to use them. Hit that like button if you found this valuable, subscribe for more tax saving strategies, and drop a comment if you have questions about real estate tax strategies. I read every comment and often turn them into future videos. Thanks for watching, and remember, keep more of what you earn.